Reganti. Thank you for being here today.
Oh, thanks for having me.
We are live, and it's a pleasure to have you. I think it's perfect that you're going to be here because it's extremely interesting, what's taking place in the markets and in our economy right now. It's an extremely interesting time to be not just an investor, but an advisor, a strategist, an asset allocator, because I think the level of uncertainty right now is really high, at least from my, perspective. When I look at what's going on and just thinking about everything, the new administration, you have Fed rate cuts. We have no idea what's going to take place. We've heard Powell speak a couple times, but we really don't know. Geopolitics, trade, inflation, GDP growth. I mean, we can just keep going on and on. And, every year, I know we come into the year with a little bit of uncertainty and markets certainly don't like that. But I feel like this year, from my perspective, it's a little bit more than usual. So a pleasure to have you here. Thank you for taking the time.
Oh, thanks for having me.
And, before we dive into things, we'd love to give you a quick background and bio on you. So you're currently the managing director and fixed income strategist for Wellington Management. You, in addition to that, you're the publisher of Wellington's Fixed Income Monthly Drivers and Observations, and you've spent over 2 decades in the fixed income markets, both in the public and private sectors. So you definitely have a wealth of knowledge, and looking forward to hearing about it. Prior to joining Wellington in 2018, you were actually at Grantham Mayo Van Otterloo, and then prior to that, you were the deputy director of the Office of Debt Management at the U.S. Treasury Department.
That's right.
Two super cool past.
They were both wonderful experiences. Yeah.
That's awesome. What prompted the transition from job to job? Was there anything specific that made you want to switch?
No, I think it was just as your life and career are sort of meandering at certain points. You make some decisions. My move to the public sector originally was following the GFC.
Okay.
I was a portfolio manager in Chicago, and I felt like I wanted to be helpful and useful in trying to, reassemble, I guess, a lot of the sort of damaged parts of our financial architecture following the crisis. So, lo and behold, this narrow point in time, my skill set in bond markets was useful to the greater public versus just sort of the day to day. So, I moved to DC and took a job at the Treasury Department, which I thought I would do for a year. I ended up staying for 4 years. I had just an amazing professional experience. Learned an enormous amount looking at the world from that side. And I had always viewed it as something I'd just do for a few years and return. So at year 4, I started looking around, and a firm in Boston gave me a call, and that was the folks at GMO. And I went there for a number of years, and just a really great group of people who I'm still very close friends with today. And a firm down the street like Wellington had really been focusing on continuing to expand their fixed income franchise. And that's how I started having a discussion with them, and eventually, it's now been 7 years, moved over there.
That's awesome. Yeah. And, Wellington's not a firm that's, in the public eye that often. And, they're not publicly traded either. But they're a bellwether. They really are. How's the experience been like with them so far? And, tell us a little bit about that.
It's been an incredible experience at the firm. You're right. We don't have what I'll call this, massive sort of popular public facing presence. And to some degree, that's probably been, on purpose. Our view is our job is to serve our clients and kind of keep a low profile. But when you realize there's this firm in Boston that manages $1.2 trillion and is active in so many different parts of the public and private markets, it's pretty extraordinary. And then, of course, the offices stretch from London to Singapore to Hong Kong to Australia. It's a global firm, even though it started in Boston. So for me, when I was working there, it was just utterly incredible, the type of conversations that I have with colleagues who would come from all over,
Yeah.
right? That, they had been people who had started as, analysts and grew and spent 30 years covering an industry, or someone who moved over from the Bank of England and like was, spending their time thinking about what was happening with European rates. Like, so for me, it was like in the geekiest way possible, really just a wonderful kind of intellectual experience, and it continues to be that way today.
Yeah, that's fantastic, and that's that's the cool part of finance.
Yeah,
is you get to meet people from all over the world, and a lot of let's use like England for example.
Yeah.
The markets there are different; they operate differently, but a lot of the objectives and goals and the way people think are still the same.
Yeah.
And different. So it's great to hear those perspectives, and there's always stuff you can learn from people in other parts of the world that have similar jobs as you.
Oh, absolutely. And it's not just their perspectives, it's also trying to think about like how capital markets fits into like the societies and government models of what you want your the country to look like. So in England or in Europe, you have something that's slightly different from the U.S. And then, of course, in China, you have something like radically different.
Yep.
And in many ways, you're trying to understand the role of capital markets, the iterative role, really, right? Like how it impacts those places and how those places impact the markets. And that's just something that's a forever kind of learning experience. Yeah.
Well, let's dive into some of the specifics about what's going on in the markets today. The fixed income landscape is really interesting. Yeah. And, having over 2 decades of experience and, watching how these markets trade and play out, when you look at the market today, do you consider it a normal market environment, or do you still think we're sort of in like a strange time for fixed income?
Yeah, wow, it's a slightly loaded question, right?
Yeah,
Because if you think about it, I mean, no market environment has truly been normal for us, as we worked in the decades, right? Like we had a pandemic just, a few years ago. And during and after that pandemic, we had like an extraordinary amount of financial actions taken by the Federal Reserve and Treasury and policymakers everywhere. And, if you go back just 10 years before that pandemic, we had an earth-shaking type of financial crisis. So I kind of feel like I look at these last 2 decades, it's always been some type of crisis that's arisen, and then there's a reaction function that markets have had. Now, that being said, I agree 100% with how you initially laid out like what markets feel like right now, which is an incredible amount of uncertainty. Like over the course of the last few years, the United States' growth rate has been far and away like the best growth rate among almost all developed large economies. Yep. It's just broken away from the pack in terms of how fast it grew. Now, none of that is sort of costless. Like inflation, certainly was an issue, and it's come down quite a bit. I mean, a couple of years ago, if we were doing this, it would have been like 9% inflation rates we were talking about. Now, the consensus forecast is like 2.8%, like for the year. So we're at a much different point. But the things you laid out initially that's causing the uncertainty is, to some degree, we're unsure the directionality of policy, right? Like that's kind of the big uncertain point. So we don't know, the administration's goals have been articulated as trying to rebuild the industrial and manufacturing capabilities of the U.S. Okay, but so far the preferred tool to discuss that has been tariffs, and those have a lot of different implications for lots of different parts of the economy in different ways that the market is grappling with right now. And of course, we don't know how much of the tariff discussion is bargaining versus like stuff that's really going to be implemented. So it's put a big question mark on both growth and inflation, right? And I feel like the fixed income market has been grappling with that. And then you add on to the fact of the idea of changes to federal government spending and so on. And that adds a large separate question to this. So that makes the Fed's job just much harder, and they've been sort of very slow and steady in how they think about what to do. They wanted to cut this year, but it looks like that's probably likely off the table, or maybe they get one cut in. So from a bond market perspective, even I mean, the bond markets are integrated with the equity markets. Like there was a big question mark we're arriving at. And I think the last few days of price action kind of really show that, right? That there's that uncertainty's feeding into survey data, pricing, where interest rates have been going.
Yeah, so if we don't get any rate cuts, or we get maybe one, do you think that's something that could already be priced into the markets, or what could the impact of that be?
Yeah, right now I think markets are pretty skeptical that there's likely to be rate cuts. Maybe there's a small percentage that there could be one cut. So I actually think the impact is going to be pretty relatively modest, right?
Yep.
I think the market's going to be focusing a lot on other data or other actions. So for example, the market's best expectation of inflation is looking at inflation break-evens with the TIPS market. And those have been rapidly increasing. So we're at 2.67, 2.68 on a 5-year break-even, which is actually moving upward at a steady clip. And it's telling you the market is getting more concerned about realized inflation or inflation continuing to be sticky. But at the same time, interest rates are down. And like this morning, rates were down 7 basis points across most parts of the curve. So what we're seeing is wider break-evens, but still lower rates. And what that usually means is the market's starting to be concerned about a slower growth, but yet still sticky inflation world, which is that's not as healthy, obviously, as a higher growth, low inflation sort of which is always the holy grail of policymaking.
So that's super interesting, because what we've been experiencing, I would argue, for the past year or two is elevated inflation because of continued spending from the consumer, right? The consumer won't slow down. They keep doing stuff, whatever it might be. And that has kept prices elevated, right? You can also talk about M2 and money supply and all that stuff too. But for the most part, it's been, the consumer just not slowing down at all. But now you're saying that the consumer could slow down and inflation might not slow down either.
Yeah, so I think this is this is a really interesting point you've raised. So the consumer, yeah, you're right, was on fire over the course of the last year and a half too. But it's what was the groundwork for that consumer to be so confident? Well, a number of things. First of all, most consumers and households in the U.S., there's been a substantial deleveraging of their balance sheets since the global financial crisis. So if you watch sort of consumer household debt and so on, there was downward pressure following the events of 08 and 09, and that continued for years. If you take the pandemic out of it, that trend was still heading downward. Then when you had the pandemic, there was a lot of federal stimulus that moved into the system, both in terms of direct payments to people, but additionally, just sort of broader aid, state and local governments received payments through the American Rescue Plan. And there was the CHIPS Act, which was spending for semiconductors, the Bipartisan Infrastructure Act. So large segments of our population or society were receiving these pretty large spending packages from the government, and that stuff moves two ways. It moves into wages and corporate margins, right? And that was very sort of stimulative to the overall economy. So you had a consumer that was already delevered, was receiving generally pretty healthy wages, and then they saw really tight labor markets, right? They had no concern about being fired or being laid off. And in fact, you could look at Powell used to refer to the number of job openings out there versus the number of jobs being filled, and there was a very significant gap. And people were quitting their jobs at pretty high rates because they could always get better wages someplace else. So all of these over the course of 2023 and 2024 was showing just exuding the confidence of the consumer. Now, I think things are a little bit more balanced, right? You don't see people quitting their jobs as much as they were. There's even a thing called the quits rate, right? Which is back down to pre-pandemic levels. You're starting to see a toll being taken for people who are more dependent on financing for things like cars and so on, because interest rates are higher. So you're kind of chipping away at that. And then other things sort of remain from an affordability perspective, housing and so on, remain really difficult. So what you have is a consumer that's less confident, and you could see that. And then additionally, you have the stickiest part of inflation, and this is the part that's the stickiest part of inflation, if I take tariffs completely off the table, has been the housing and shelter component.
Yep.
And that should move down, but it might not. And the reason is that we underbuilt housing for the better part of a decade. So even if demand sort of abates a little bit, there's still kind of a squeeze on large parts of the housing market, especially like single family.
Right.
We're hoping that the weaker multifamily data starts feeding into the inflation data faster, and maybe you'll start seeing inflation tick down. But that's not fully guaranteed. So you can literally have a scenario where you're seeing weaker consumer spending, like that, but you could still see sticky shelter. And then there's also like the impact of if equity markets, show any kind of weakness, that's going to feed back even more into the consumer wealth effect, right? So I feel like we're sort of at a fulcrum point here. And maybe fulcrum's too harsh a word because that feels very narrow, but maybe like a plateau part where we're not sure directionally where things could go.
And eggs have been going crazy.
There is the egg issue as well. There is the egg issue, yeah.
That's funny. So you mentioned auto loans in there briefly. Do you pay, so I'm going to quote Bloomberg, U.S. auto loans, 90 plus days delinquency hits 3% in Q4. It's the highest in 14 years since the GFC. Is that something you guys pay attention to? Or
Absolutely.
Is it just,
I mean, we spend a lot of time looking at consumer health. But for example, my colleague, Kira Fekta, who is a securitized credit portfolio manager, like she spends a lot of time thinking about the consumer, like on autos, on credit card, all of these things are tradable debt, that are in the market. So understanding, the credit quality of the underlying borrower is really critical to deciding whether or not you want to be part of these deals or buy pieces of them. So one of the things is like, in a way, there's almost like a K-shape that's coming out, right? The subprime and weaker and prime sort of borrowers are getting more and more squeezed by these high financing rates. And at the same time, you have a portion of the market that really has like a huge equity sort of portfolio position as a percentage of their total assets. And they're like, things are great for them, right? And to some degree, like, if you've ever asked the question of like, who are these cash buyers of houses, right? Like, well, it tends to be these older couples that have large equity positions that they can liquidate and purchase a house without worrying about mortgage rates at all. But on the other end of that food chain are like these borrowers who are very sensitive to interest rates. They don't have like a large pool of capital to deploy if they need to do it, but are still dependent on buying things like cars and so on, in America to get to work.
Right.
So you're starting to see weakness there, and it's creeping up. Now, is it enough to what I'll call derail the overall economic strength that the U.S. is? No, but is it enough to slow it down? Is this additional friction? Absolutely.
Yeah. Has this taken? It seems like this is bound to happen at some point, right? With what has happened to rates, and just for the period of time that people have sort of felt euphoric about how much they can spend. But sort of what's been keeping it down is mortgage rates, for many people having mortgages financed, in low single digits. It seems like we're starting to feel the issues of having high rates.
Yeah, well, so I mean, one is you're right. This was bound to happen at some point, unless you fully believe the business cycle is dead. I'm very skeptical of people who say that. But this was sort of the point too of the Federal Reserve tightening monetary policy. It was to sort of pull back on the aggregate demand part of the economy, especially in like interest rate sensitive sectors, like as you said, in like autos and so on. But the mortgage part is the really kind of interesting thing. In a weird way, there was a supply impact too there. So what happened? Let's say 30 of your friends went and got mortgages at 2.5%, 3.5%, right?
Yeah.
And mortgage rates are now what, 6.5%? We saw 7% just over within the last 12 months. So the chances of your friends who've bought their places and have locked in financing of selling in the near term is very, very low, right? Like there has to be what you'd call a significant life event. They're moving or something like that. But what have you done then? you've taken a whole pool of existing homes off the market. Like you tighten supply when supply was already tight because these folks will not sell their houses, right? Because they have to go live somewhere. And to go live somewhere, they're going to end up like doubling their financing cost. So I do think for sort of existing homeowners, like this is an incredible trade, right? Like they've locked in financing at rates that are lower than the federal government's like financing rates, right? And there's even a tax deductibility on the mortgage interest in that. So in real terms, like they're financing their houses at exceptionally low rates. So they're very low likelihood to sell. But for the new home buyer who, is now looking for housing, it's extremely painful, right? Like you're talking multiples of what it was just a few years ago, and that could be, and that itself is a headwind. And normally that headwind would weaken home prices and would decelerate home price appreciation, except for the fact that the supply squeeze has been pretty painful too, and was exacerbated to some degree by the fact that existing home sellers are probably less in the market than they were before.
You think we're going to see an uptick in supply over the next few years?
So you are seeing some uptick, particularly in the multifamily side. If you go to some cities, sort of like destination cities in the South where people have moved to for the last few years, well, yeah, you're actually seeing cuts to rent and so on. So, and if you look at like hard data, aggregate data, the Cleveland Fed puts out what they call a net new lease data index, which shows like, well, what's the percentage change of like new leases? Like that's important data, like the new leases, right? And it showed a pretty downward decline. And then if you look at Zillow and so on, so you're seeing like downward movements in like the rental side, which is reflective of landlords, wanting to get these places like leased out, and clearly like a lot of supply. But in some places, particularly on the single family side, like, supply still remains relatively constrained. And the issue here is it's very hard to solve with like a national kind of answer. Building is a state and local government issue, like zoning, like town council meetings, hearings on whether or not like you can upsize a 3-story apartment building into 4 stories. Like these are very contentious issues, and have served as a significant headwind to really supplying the amount of housing that Americans need where they're at, right? Like in terms of where they're living. I mean, you and I live in the Northeast. Like we know, like firsthand, like the supply of housing is far below what people actually need up here. So.
Right. Outside of all that macro data, is there anything else keeping you up at night when you think about financial markets? Particularly on the fixed income side.
Oh yeah, I mean, lots of things. In fact, we've published on our monthly like a section called "What's Keeping Us Up at Night" because there's just been a number of things. Look, we're seeing the slow unwinding of a consensus that existed for most of our investing lifetimes, right? Which dates back to the 90s, and it was called the Washington Consensus, which was a consensus that peer or friendly nation states tend to have freer and more open trade over the long run, and that this was like broadly beneficial to all parties involved. And now, of course, looking back, we know it's beneficial, but we know it accrues in some areas, and others, it either doesn't accrue to or is painful for, right? As jobs and so on shift, can shift or did shift. But capital markets were built to some degree on these assumptions. And now they're trying to realign in an era where that consensus is like done, full stop. And then second, it's taking place against a backdrop of substantial geopolitical uncertainty. There was, a war, a 3-hour flight from London.
Right.
Like that's mind-boggling when you think about it. And not like a small conflict. You're talking like a front hundreds of miles long. And Europe is one of the largest trading partners of the United States. There is what you'd call intensifying competition between us and a country that effectively is the world's manufacturing floor, which is China. What does that competition mean? Like, are you trying to replicate those manufacturing capabilities wholesale, or are you trying to compete in certain narrower industries?
Yeah.
And these questions are ones that everyone's grappling with. And I think markets actually are uniquely bad at understanding those things because these aren't things you can model for, right? They're policy questions, and policy questions aren't always about optimization. They're about resiliency and addressing, needs or goals of national, dialogue. So for me, when I look at like the overall marketplace, I feel like both volatility and uncertainty are mispriced. Like there isn't enough, like there's a more, the trade of the last God knows how many years is buy it and forget it to some degree, right? Like and the realization is it's unclear whether that perspective will work in the same way that it has worked, because a lot of the assumptions that led to a lot of the growth are now being debated and unwinded in a lot of ways. And what do things look like after? Well, that's the $23+ trillion question, right?
Right. Yeah. Right. Do you think we're going to have significant pressure from a country like China geopolitically if we continue to see companies like Apple move a lot of their production back to the U.S.? Like there was an announcement recently about how they're going to invest a bunch of money in the U.S., add a bunch of jobs, and do stuff like that.
So it's a big question, but it's less about Apple, a very sophisticated producer of consumer goods moving, stuff here or there. It's about like the stuff we use every day, right? And what I mean by that is, you have a population. You have to figure out what choices you want to make on what you want to make, right? Like, do you want to make everything? Well, if you want to make everything, like ranging from like this plastic bottle sitting on my desk to highly sophisticated computer technology, do you have the population scale and size? And how long does it take to build everything? And what I mean by is, if the shop floor, the manufacturing floor has already been built, and you are replicating kind of that, what's the margins on replicating that for, the return on equity for that? In a lot of cases, it's probably unacceptably low for, but in China, that discussion has to do more with what are the strategic priorities of the country in maintaining and developing its manufacturing prowess, right? Like that's a national project. If you want something of that scale to take place in the United States, it's not something that is done in 6 months or 1 year, but for the rest of our lives. Like it's a project that has to go on, right? You need everything from the engineers to highly sophisticated workers who every year, whether it's sort of profitable or not, are honing like how good and how fast you can make something. So I don't, from our perspective at Wellington, like it doesn't, I think this sort of economic competition doesn't look like it's going to abate anytime soon. And certainly, you can see headlines of individual companies, like you mentioned, but this would be a generational project. And generational projects literally need the buy-in of everyone, right?
Gotcha.
Because they can't be subject to, there's a turnover administration and there's going to be a new set of priorities. It's like the priority.
Right.
And that's really hard. You have to forge that consensus in U.S. society. So from my perspective, this tension when it comes to industrialization and manufacturing is going to be something that's going to be a feature of markets for a long time.
Right. And the turnovers could be pretty quick too, right? Because we could see something over the next 4 years that promotes that theme, and then the 4 years goes by and it's, turned in the other direction back to how it's been.
Correct. And also it's not just, we want to produce, you want to produce, I'm going to just use, like, as you mentioned, Apple products here. Well, what's the supply chain for those, like the components? Like, are you going to produce all of the components, like soup to nuts here? How efficient is that versus how resilient is that?
Right.
Okay, so then you want to maybe partner with other countries where some components are made someplace else and some components are here.
Right.
Okay, well, which countries? Like, are there, like, do you want to do that through tariff or incentive policy? Do you want, those are incredibly complicated questions, right? And it's hard to do those with what I call sort of sweeping one-size-fits-all policies. So one example is there's a significant debate now on whether or not there's going to be tariffs on steel inputs, right? And the goal obviously would be to try to revive the nascent sort of
Right.
steel production in the U.S. But what does that do to the auto industry in the meantime, right? It takes years to like get steel capacity online, but if that's the case, then the importers of that steel are effectively
Right.
going to have to figure out a way to pass through that cost or not. And this is kind of why, and this is probably a little bit too historical, in the late 19th century, in the 1880s and 1890s, a significant portion of federal revenue came from tariffs. But the fight against it was, interestingly enough, led by Southern farmers who hated the idea that their crop prices were so low, but their input costs they had to import were so high.
Yeah.
So they were like almost like the vanguard of trying to change that. And hence, in 1913, we actually passed an amendment to have the income tax like codified into law. It was because it's really hard to calibrate these things to always achieve what you want. And you end up like, helping one industry and hurting another. And then you have to figure out like net, was that a positive, right?
Right.
So, yeah.
Right. Do you guys have a view on what the tariffs could possibly look like?
So I wouldn't say what we'd call like a strong view, because at the end of the day, like both Congress and the administrations have announced, delayed and so on with a number of the tariffs. But one kind of thing that's sort of been salient and sticking out to us is the negotiations going on right now in Congress with extension of the tax cuts that were passed in 2017.
Right.
And there is an important question on whether or not tariffs are going to be used as a pay for, right? Like to effectively say, oh, hey, there's going to be this budget gap, and to win what you'd call like a faction of the House of Representatives, there has to be a pretty substantial pay for. Tariffs, as articulated by, 50% tariffs on China, which was one of the original talking points, and 10% on the rest of the world, would come close to, quote unquote, serving the pay for on that. But then, this is what I'll call like the first derivative, right? Like the second derivative in this is, well, what happens if there's retaliatory tariffs, right? You could expect these countries to retaliate. And then if there's retaliatory tariffs, what does that do to growth? And if growth declines, what does that do to tax revenues? And if tax revenues decline, like, does that end up effectively widening out, like the very thing you were trying to? So, or what happens if the dollar appreciates and causes even a bigger, trade deficit? Like, so like there's these second or third order effects that are very, very hard to like circle, adding to that uncertainty that we were talking about. So one thing is we are watching to see if tariffs will be used as what I'd call like a pay for to extend the tax cuts that are set to expire. And if that's the case, we think those tariff numbers would be pretty substantial. What we don't know is what the follow-on tariffs would be. Now, we've heard, obviously, more locally that 25% tariffs on Canadian goods and 25% on goods from Mexico. We think of that as more negotiating to renegotiate the U.S.-Mexico-Canada trade agreement, and don't think our base case is that those are going to come on full. We think those as bargaining positions. But net, yes, there's a high likelihood there's going to be some sort of global set of tariffs.
Do you think if we see substantial cost savings from the Department of Government Efficiency, or DOGE, do you think that could offset the level of tariffs that we might see?
It's unlikely, and I'll tell you why. It's because if you break down the federal budget, like between the two big chunks is called mandatory and discretionary. And mandatory is one of the largest, and it's basically determined by formulas that Congress has set. So what we're talking about is Social Security, Medicare, Medicaid, SNAP, income security, which is like veterans payments and so on.
Right.
And then discretionary, which like half of that is defense, right? So like almost 3/4 of your federal budget is going toward mandatory and defense related items. It's really like, unless you're kind of looking at those things, and those are the third rail of American politics in the sense that Social Security, Medicare are things that people feel like are critical to the standard of living they
Right,
maintain,
right.
especially among the retiree community. And of course, defense. We just went through this whole discussion on geopolitics. There's very little, I think, appetite to reduce defense.
Gotcha.
So the other savings, Doge is articulating is coming from looking at waste and fraud and so on. Now, here's the thing. I mean, I'm a former, government employee. There's like three important levers in terms of like determining whether there's like waste and fraud. One is you already have congressional oversight, right? Congress has committees that literally oversee each of these agencies and then make them go through the third degree every year as they sit and like, well, how'd the money work for this and how'd it work for this? Two, there's usually inspector generals within each of the agencies whose job is to like actually look for fraud or even mistakes, right? And then three, there is an auditing firm called the General Accounting Office, which literally serves as a group of people whose job is to look at large programs the federal government's doing. So I think, I'm sure there's like things that, will be picked up, but I don't think it's going to be in the amount kind of expected to offset some, like revenue loss like that. That's a very, very big number. We're talking like 1.5% of GDP. It's like massive, right? And I think, so I think that's kind of like the issue with that. There's certainly programs, you might not like. There's certainly programs where like, shouldn't Congress cancel this or something? But that's different. That's just like, I don't like the policy versus this is like waste per se.
Gotcha.
So I think it's a very steep hill for them to climb. And I kind of think it's kind of unlikely. And the numbers they've published so far on their website don't seem to really be in line with what I'd call substantial cost savings.
Gotcha. We could keep talking about all that stuff.
Oh, yeah. We could keep going for a long time, yeah.
Let's go down another path.
Yeah.
You've recently written an article or, updated your white paper about, 5 reasons, to be active in fixed income right now. Let's go. I'm going to go through those 5 and would love to, hear you elaborate on them.
Yeah, absolutely.
Awesome. So the first one is performance potential. It's pretty self-explanatory, but
yeah, I mean, just historically, active managers have outperformed like a widely used benchmark, like the Bloomberg Aggregate Index, which is like the largest bond index that's used in markets. And they've just consistently, it's been one where the management teams at a whole bunch of places have just done better than. So to me, there's a concept of like, if you believe there's a value add and there's alpha and it's historically there, like there's a good chance like, you're going to reap some of those benefits.
Gotcha.
Yeah.
Market structure.
Yeah. So fixed income markets are nothing like equity markets, which is something I like to keep telling my equity colleagues. There's no exchange. There's no central place to go buy these bonds. It's a fragmented world, right? So bonds are bought and forgotten about and held by some portfolio manager somewhere. If you need to buy really big enough blocks, you have to pick up a phone, like our trading desk, and call around, right? But you can't call around too much because you don't want everyone to know you're looking like for these bonds. Like, it's very fragmented. You have actors in it who are doing things for non-economic reason, meaning they're doing it for regulatory or policy reasons. So they're it's a central bank buying bonds. It's an insurance company trying to hedge out their liabilities, or a pension fund, hedging out their liabilities. Like, they're buying the bonds for different reasons than you buy the bonds. And it creates distortions in pricing. And it's already what you'd call opaque to some degree, right? So like, if you're active, you're nimble, like you are, ideally like picking up bonds that you think are at better values than the intrinsic value, or where you think the larger macro economy is going. And I think actually just a wonderful, extraordinary thing about bond markets. So when I tell someone like, oh, the bond market's opaque, it's fragmented, the market structure is non-economic players, as an end buyer, I think of that as a good thing, because there's value to be had from that.
Right. Gotcha. Can you elaborate on the part where you mentioned there's no exchange?
Yeah.
So if a company wants to issue bonds, explain that process.
Yeah. So typically, what a company will do is they'll hire one of the dealers, on Wall Street, to be the underwriter of the bonds, and this dealer will go out, and their bond salespeople will call asset managers, large and small, usually starting with the largest ones, because that's the place they can place the biggest block of bonds.
Gotcha.
And there's a syndicate desk at the dealer, whose job after all the subscriptions come in is to divvy all of this up, and at what price, right? Like, so the market is going to set the price of that bond, the coupon or yield of that bond. And then it's distributed, and then it becomes traded like actively on the secondary markets, and it stays actively traded for a while. But like if that company's only issued 1 or 2 bonds, 5 years later, like you actually have to go find those bonds if you want to buy them.
Right.
Very different from a dealer. I'm not a dealer, but a company that comes to market like every year. Like a lot of the banks come to market every single year. So this system I'm talking about, some of the computers are better. Like, people aren't writing things down on paper tickets anymore. But like, if you had gone back 30 years ago and you bought like a bond trader back, there's going to be aspects that they recognize from this. And from, it's very different than like the stock exchange where I want to go buy company XYZ.
Right.
Like there's an exchange, right? There is none of that in the fixed income market. You have to call the market makers to find out where you can get these bonds.
Very interesting. The next one you mentioned is credit deterioration.
Yeah. So when you are a passive investor in fixed income, you could have large issuers, especially on the corporate investment grade bond side, which makes up almost 30% of the index, like deteriorating in credit quality. And credit deterioration, can happen slowly and over time. And if you're passive, you're just going to ride that thing down, like as it becomes a worse and worse credit. From my perspective, one of the best sort of risk management parts of being an active fixed income person is, your credit analysts are there to really spend time looking at those issuers and determining if the path forward is that they're going to be weaker or stronger credits. And even if they get weaker, is the market pricing them, too weak, right? And does it make sense to look into that from a valuation perspective? When you're passive, you don't get any of that. You're along for the ride, right? Yep. Even though that ride can take several years, and I think it can be frictional to returns.
So you have a really interesting chart in this research report showing the share of triple B bonds, and how over time it's just continued to slowly increase.
Yes.
And I'll actually quote you in that report. A prominent concern amongst investors is that lower rated credit now comprise a larger share of investment grade credit in credit universe than in the past. Yeah.
So if corporate bonds are rated by the national rating agencies, Moody's, Standard & Poor's, Fitch, from AAA, on down, right, to C or default, is like most of the scale. So the large index I mentioned, the Bloomberg Aggregate Index, tends to have BBB- Baa3, as the lowest a bond can be before it's kicked out of the index. So what we've seen over the years, like if you go back from when I first started 20 plus years ago, there were AAA companies and AA companies. You've seen the credit quality deteriorate, move down. And why that was the case was corporate treasurers felt, for a variety of reasons, that they should operate with more leverage, more debt. And because they had more debt, the rating agencies moved them down on the notching. So what you saw was the investment grade index becoming poorer and poorer quality. Now, you as a passive investor, you don't get an opinion on that. You're just you just take it. Now, but there's something interesting that happened on the flip side of that. If you look at the high yield index, the US high yield index, over the last 15, 20 years, the credit quality actually became better, right? You used to have a very large share of triple C companies. And now, instead, what's happened is you've squeezed up. And there's a lot more double B companies. So on one hand, you have this investment grade corporate index, which it's investment grade, but the credit quality is deteriorated. On the other hand, you have this high yield index, and high yield, which people will say junk bonds and all these, but yet the credit quality is improved over the last decade or so. And so the directionality of these indexes, each with one name denoting very high quality, high confidence, the other denoting one that takes more risk, and it is still more risky, but it's improving credit profile versus a deteriorating credit profile. But an active manager can be like, oh, hey, maybe I don't want some of these triple Bs. Maybe I'll buy some double Bs because I'm getting much better spread. I think my credit analysts tell me these companies are going to do well, and I'm out earning the triple Bs. And the triple Bs, by the way, has come down from single A over the last few years, while this double B used to be a single B before. Like, you don't get that in the passive side, right? You get that on the active side when you're picking individual bonds. So I'm sorry, I get kind of excited about things like that. Yeah.
Let's definitely want to put a pin in the comparison of high yield to investment grade bonds. One quick question I thought of: do rating agencies change their criteria over time, or do companies just fall in and out of certain categories?
Yeah, it's funny. My very first job was a credit ratings advisory analyst at an investment bank. So I literally would have to mimic and understand the agency's methodology. So the methodologies vary from agency to agency. There's difference between Moody's and Fitch and Standard & Poor's. Some of them say what's the rating is a probability of default kind of. Others are it's a probability of loss given default, meaning after the bond is defaulted, what's the recovery rate? And there's important differences. And even within their analysis, some industries are allowed to sort of take on more debt than other industries because those industries have been considered super stable, super boring, and maybe the ability for new entrants to come in and threaten those business lines.
That could be like a consumer staple.
Yeah, something like, right? And I'm not saying there's dramatic differences, but certainly something like that versus, let's say, a commodity-orientated borrower where they're sort of living and dying by the price of like that commodity.
Right.
Like there's clearly more leeway in the business structure of like that slow and steady company to have a bit more debt than one that has a more volatile input. So yeah, there's differences. Do they change the methodology? Yes, but it tends to be one that's like done over a long period of time, and it tends to be on really obscure things. Like, how do leases like count in like the credit quality of a company?
Yeah.
Is a lease really just another form of debt? Like debates like that, right? Like are what like the credit folks really spend their time talking about. So if there's a methodology change, usually there's a publication saying updating the methodology from one of the agencies, and it's been one that's been sort of well studied and debated, and it changes things. Yeah.
Very interesting. The next category you mentioned is dislocations within the market.
Yeah. Okay. So I'll give you this great example. When I told you that markets and fixed income are fragmented, the interesting thing about it is just because you're a seller, because there's no central exchange, doesn't mean there's a buyer at that time, right? And especially if you, and let's say 3 other, entities just like you are selling at the same time, maybe there's no one on the other side who wants to buy it. Now, in the old days, if you're an investment bank, your job was to buy it and then hold it in your inventory until there was a seller. But there's been a pretty big regulatory change, over the last 15 or 20 years. Sorry, it's been about 15 years now. I keep dating myself. But over the last 15 years, where the dealers are much less likely to want to hold on to those bonds. Like they don't necessarily want to inventory. They want to just be the person in between, buying and selling as quickly as possible, right?
Right.
So if there's a large group of sellers at one given point of time, that means, there has to be a buyer who's going to sort of step up and buy these things. In April of 2020, we saw a really interesting phenomenon, which was a whole bunch of hedge funds had to sell a certain type of bond. And the reason they had to sell that type of bond, is because they had borrowed money to buy that bond.
Right.
And the dealers had extended them credit to buy it, right? And that credit was secured to these bonds. But at a certain point, the dealers were saying, oh my gosh, like this is such a crazy market. We don't really understand the implications of COVID over the year on the economy. Our risk managers are like, guys, you gotta reduce your balance sheet, right? So one of the first places they'll cut is the ability to lend to some of these hedge funds. So these hedge funds were like, oh my gosh, well, we don't have cash to buy these. We've been using borrowed proceeds. So we have to sell this stuff, right? And they're selling it, and they really need to sell it almost like right away. There's nothing, there. So at that point, what you have is bonds that are available for sale that are far below what we call like our estimation of intrinsic value, right? And if you're large and you're liquid and you have a good trading desk, you're one of the first phone calls, right? So you have the ability to take those bonds on, and you can help dictate the price. So this is that's an extreme version of what I call dislocation, but like it gives you some insight. And if that happens, like then smaller sort of things like that happen a lot in the bond market, and sometimes just a few basis points.
Right.
But you want to kind of keep your eye out for that, and then you want to be a liquidity provider. You want to be able to deploy your capital to buy these things when others are forced to sell. So I think that's actually a really powerful part of bond markets.
And then the last one you mentioned is divergence.
Yeah.
And on the surface, that can sound very similar to dislocations, like you just mentioned.
Yeah, so dislocation can drive like divergence, but other things can kind of drive divergence, right? Which could be supply, right? Maybe there's like oversupply of a certain type of bonds coming from the issuance side, or maybe the Federal Reserve bought all of these sort of types of bonds. So a lot of these things can cause like divergence in pricing. I think like a very interesting one right now, or less so now. I mean, it's still interesting, but over the course of the last like year or a couple of years, one place that's sort of been punished from a valuation perspective has been the commercial mortgage-backed market, right? Bonds that back the mortgages of against properties, right? And they can be lots of different properties, office parks, industrial warehouses, and so on. And prior to the return to work, like who wanted an office park in some, suburban, like these were, properties that we're going to have a hard time getting refinancing. And some still continue to do that. But there was so much headline risk, I think, around this that large parts of that market started trading really, really cheap. Okay, but like if you look at the bond, you look at the tenants, you look at the documentation, you look at the valuation, and then there's a chance you can maybe pick up something at like an attractive price. But a lot of people also stay away from it because of the headlines, right? Like you don't want to explain even though you're like, look, a lot of things kind of got thrown out with the bathwater, and this is where you want to really kind of dig through the basket and find stuff that you think are going to pay out. So divergence can come from a whole host of things. Dislocation is certainly a related one. I think of dislocation as more of like there's a forced seller in the market, and the ability to warehouse those bonds isn't what it was in like in the old days. So if you have the ability to, you can take advantage of that.
With no exchange in the fixed income market, and you just mentioned headlines, which made me think, do bonds experience the same type of psychological issues, I guess you could say, that stocks do? Whereas you can have an investor who's super emotional, right? Headlines come out, they make emotional decisions. Yeah. Do bonds have a similar trait?
Yeah, I think every market has that sort of human emotion psychology to it. I mean, Keynes even quoted a term called animal spirits, right? Which the whole point was when the market is having lots of animal spirits, like because of expectations and so on, there's a really positive view of that. Or we'd maybe call it vibes now, right? Bond markets have the same kind of thing, but with generally with a lot less volatility than the equity market. So one of the uses of bond markets is I want to get some type of return, but I want to dampen the volatility of my overall asset allocation. And while there's volatility certainly in the bond market, I expect it to be less than the equity markets. And and there's a spectrum of that. Like in the government bond market, it should be a lot less, right? Because it's a government bond. Right. But in the high yield market, it'll be less, somewhat less, but it won't always be a lot less, right? So yes, I do think there's that factor of emotion that still comes into bond markets.
I think that's a great way to tie it into how we can view fixed income and its role within a portfolio today. So broadly speaking, would love to just hear, sort of your high-level views on how you view bonds and portfolios today.
Yeah, I've always viewed them, and some of these characteristics are stronger at certain times than others, as first and foremost, a diversifier of risk over the long run, right? Over a couple quarters, there can be a lot of correlation, but over the long run, it should be there as a diversifier of risk. It should be the flight to quality, capital preservation like vehicle for your asset allocation. A place almost in a way where you want to, make sure that if something awful happens in the equity market, there's still a substantial portion of your allocation that's there. The second is it should be liquid, right? Like there's all kinds of spectrums in bond markets, but broadly speaking, the further you move away, the public fixed income market, while I've talked about these bouts of dislocations and so on, like broadly speaking, it trades still pretty well, and the higher quality you go in it, like it's going to trade much more liquid. The third is should be income generation. Now, it felt like 3 years ago or 4 years ago saying that was kind of like a joke. Like at one point, I think the 10-year Treasury hit 59 basis points during the peak of COVID. We're at a different place now. Like, as of this morning, I saw 4.33 on the 10-year. So like 4.33%, of what effectively is principal guaranteed, right? So it's throwing off a very significant portion of income, and if it's part of a fund, you can probably do better than that, right? Like much better than that even. So that income generating capacity has really roared back, right? Like in a way that I think was painful in 2022, but now is like sticky and there and kind of like wonderful. So I always thought of bonds as like this risk offset, like this. It's a horribly flawed term, like fire insurance, right? Like, but like in 2020, you were paid nothing. You were effectively paying up quite a bit to do that.
Yeah.
Now, like you're actually getting paid. You're getting paid this coupon that's pretty healthy, mid-single digits, for something that's supposed to make your portfolio less volatile. So, and like the point we spoke about earlier about uncertainty. Well, like in a more uncertain world, and I don't see it dampening anytime soon, I like the idea of kind of locking in something that's going to generate income where gives me the flexibility to pivot into riskier assets, ideally, if the opportunity set gets a lot more attractive.
Do you have a preference of short duration bonds or long duration, or sort of a balanced approach?
Yeah, I like to think more on the intermediate side these days. So I prefer the 1 to 10, part of the space. So one, I think, the 30-year part it's a little hard, I think, because the volatility and pricing there can be more than what people expect. Because the longer, for people who care, the longer dated a bond is, the more sensitive it is to changes in interest rates. The dollar price moves a lot more. The second is, I think it tends to be one of the first places that reacts to what's just happening in the broader world. It's also really liquid. My preference, as someone who comes from an active manager place, is let your bond portfolio manager decide, right? Like there's some points where it's like great to be in 7 and 8 year bonds, and other times it's better to be in 3 or 4 year, right? And ideally, if they're working hard, they're trying to get you like that, the more optimal expression of where we are in the market in the cycle.
Is there ever a time and place where it's necessary to go out to longer duration bonds, such as 30 years? Yeah,
I mean, so there's one, it's part of like, first of all, it's already part of like the sort of major indexes, like the Bloomberg Aggregate Index, which goes from like 1 to 30 years. But specifically, like, do you want to go out there by yourself, kind of, versus like a portfolio manager who might at times decide the 30-year point on the curve is better than the 10-year point on the curve? I think the one place you can do it is dollar for dollar. You need less 30-year than you do 10-year in your portfolio. And what do I mean by that? There's a capital efficiency argument to be made there, right? So if you're buying the bonds for income, well, if the 30-year, first of all, if the 30-year point of the curve is substantially higher than the 10-year, great, you're getting more income. But if you're buying it for diversification, how the bond math works is that the 30-year point is more volatile to interest rates than the 10-year point, and therefore you need less of it, meaning you're achieving, that diversification using fewer dollars. But you got to calibrate that. Like that gets pretty nuanced when you do that. But there are times, and it could be because of the shape of the curve for the income effect, or it could be because you think, yes, I want bond exposure, but man, I don't want to give up a whole bunch of other stuff. So I just want to add a little. Well, that little on the 30 year is quite a lot in actual, in terms of like how the portfolio construction goes.
Gotcha. I don't have you all day, so let's dive into private credit before we finish up.
Yeah.
This space is booming.
It's changed, yeah.
Do you think this will continue? Just the overall boom and demand for private credit?
So I think the answer is yes, with a caveat. So the first thing is, I'm not someone who's just going to say, I hate private credit. I get in fact, I think in 2023 we were probably saved to some degree from a significant economic slowdown when SVB and First Republic were going through their troubles. What you saw was on a lot of survey data, bank lending officers were beginning to pull back, right? Because it's understandable. They're seeing peers in trouble. They're not, wanting to be super aggressive at that point. And that could have slowed down the economy substantially. But the private credit folks just kept fundraising and deploying capital, right? So you had this other sort of channel of credit, which I think was pretty beneficial at that point in time. Additionally, private credit is sort of expanding from the institutional space into the wealth space. So there's a whole sort of another group of buyers. That means more fundraising, et cetera. So I think, the growth continues. And then finally, the third, I think a lot of people on the institutional side like it is because, there's much lower mark-to-market volatility because since the stuff doesn't trade, it's not priced like on a daily basis like equities and fixed income. And optically, that looks nice.
Right.
I'm not saying it is. It's a good thing, but it optically can look nice from portfolio construction perspective. My concerns are, anytime, historically you've just seen rapid growth of an asset class or industry, there has to be some growing pains and some learning by doing. And that, has to come when there's a turn in the credit cycle, meaning the real proof in the pudding here and how this stuff is going to perform is if we have like a really bad credit market like we did in the early 2000s or we did in 08 and 09 and there's a spike in defaults and so on. And then to me, I don't care how you model something out, the real proof is when stuff happens, right? So if you have an event like that, I think that's going to be a really important test of how private credit performs. The second is I'm a fan of just continuously more data so that allocators can really spend a lot more time analyzing it. Academics can spend time analyzing it. Public policy officials can really dive into it. And I think there's a healthier, robust debate then. And sunlight to me is one of the best disinfectants of markets, right? So I think that's really good. I mean, granted, I'm the one who said fixed income markets are opaque and fragmented, but there's actually still a ton of data out there, a lot of data about those markets. So I think the trend of producing more data should and will be a good thing. And I think that will help us better understand of what is this sort of platypus, right? Of a market which, looks and sounds and feels like old commercial banking lending, but yet the returns are substantial and it's, the underwriting is customized and it's done in fund format rather than a regulated bank institution. We need to know more and learn more. And even if you're not involved in that market, it's important to learn and know more because if something untoward happens in that market, you better believe it's going to ripple out into public markets. Yeah.
That's really interesting. Can you, at a high level, speak to how private deals might be structured versus how bonds, that come to the public markets?
Yeah, I mean, first of all, the documentation is completely different, right? You're required when you're issuing a bond into market to have these sort of registration documents that are readable, available, sort of tell you the terms and conditions. And if there's a violation of that, there's often what's a committee of holders that have to go through and restructure and think about whether the terms are going to change and what that means, right? So there's a lot of what I'd call creditor rights. In these type of deals, it tends to much more be customized, right, between the lender and the end borrower. The amount of publicly available information is going to be a lot lower. And it's going to be really at the lender's discretion if there's a change they need to make, borrower needs more time or the coupon payment is they could agree to that. They could extend or they could do a number of things in it. And that makes it much harder to compare these two types of things. Like it no longer becomes an apples to apples comparison. It becomes an apples to something else, mangoes or something, right? Where it's still a loan, it's still a credit, but the terms can be more dynamic. I think the second thing is just I talked to you about that whole syndication process that occurs on the public side. That's not quite what it's like in there. There could be more than one lender into the deal, but it's going to be a little bit different for obvious reasons. And the third is it's just not tradable in the same way, right? I mean, in some markets, what they call the investment grade private placements market, which is like a high quality market, there is some tradability. But when you and I are talking, private credit, most people are thinking of the direct lending middle market side where, you've made the loan, you own that loan, right? Like that's the world, right? So it's kind of your ride or die, right? With that company. So like all of those are really different than the public market where if we hate the credit, like it's moved to triple B, we can sell it. And chances are we can sell it in pretty good order as long as there aren't everyone is trying to sell at the same time, which can happen. But even then, you can kind of figure out a way to move the risk. So, yeah.
Do you see companies that, like you just mentioned triple B, right? Companies that are going down in credit quality, are they turning to the private markets for lending rather than going to public?
Sure. Yeah, absolutely. Right. There's some things that could be acceptable to the private credit borrower that might not be acceptable, not from a good or bad perspective, but just at that time, the public market isn't feeling that flavor or those terms, and they could go there. Or they could go into a very complicated restructuring situation where the private credit deal makes more sense. So from a public markets perspective, we actually view the private credit market as somewhat beneficial because there's stuff that we might not want to be involved in, but for whatever reason, the private credit lender might want to because they either have a different perspective, they have a different time horizon, or they feel like they have a different type of leverage that they can apply to the borrower.
Very interesting. It's been great.
This has been fantastic. I really enjoyed it. Yeah.
One thing I always finish up with is I like to ask our guests about one thing that stuck with them throughout their career. Could be a quote, something somebody has told you, something you've learned. So would love to hear what that experience has been for you.
Yeah. So there was a guy who I worked for. He's retired from the business, but I did a couple of years in the derivatives group at Merrill.
Yep.
And his background was that of literally like a rocket scientist, right? Like he had studied transportation engineering and masters at MIT, which, like that literally, like he's thinking about and so like this was easy for him, but this was hard for me, right? And he told me something really interesting. He just said for as long as you can, do what's hard, right? Like it'll pay benefits later. And I think that's really important to markets. I don't think I was someone you'd call a natural fixed income guy, when I first got my job. It was my first job. And people tend to shy away from things where there's complexity and it's hard. And I always remember every time I kind of come across this, like this guy's words of do what's hard. Because doing what's hard earlier on made me better just overall, right? You can obviously then, it's easy to do what quote unquote it's easy, though I don't think anything's really easy or particularly simplistic. But it like an athlete, it kind of gets you ready for other stuff that you can do. So yeah, I think when it comes to markets, that's really applicable. I think a lot of people love talking stocks and equities, and they're like, oh, the bond thing, it's too. And it's like, no. Spend time there. Do what's hard. There's impacts from the bond market into the equity market. And the more you spend time with that asset class and all of its sort of wonderful nuances, you'll just be better at really understanding markets. So,
gotcha. Yeah. That's awesome. I try to apply the same philosophy with life, and just every day try to do something that makes me better. And
I guess it's more broadly applicable.
Yeah, it's typically something that's not easy, but that's it. Is there a place where people can go to learn more about Wellington, hear their insights, stuff like that?
Wellington Management, just easily Googleable, and on there you'll find our insights and so on, publications, and of course our partnership with the Hartford Funds is a place as well where a lot of this material is published. So yeah. Ideally pretty easily findable. So, yeah.
Wonderful. Well, this has been great. Thank you so much, Amar.
Thank you.
Greatly appreciate it. And thank you for listening, everybody. This is the Sharpe Minds podcast. And don't forget to like and subscribe. And see you in the next one. Bye.
Sharpe Minds is produced and hosted by Michael LaFata and directed and edited by Alex Weimer. Our music is made by Tony Sapiato and licensed through Soundstripe. Michael LaFata, Financial Advisor, Archstone Financial, 508-453-9800, 324 Grove Street, Worcester, Massachusetts, 01605. Securities and advisory services are offered through Cetera Advisor Networks LLC, member FINRA, SIPC, a broker, dealer, and registered investment advisor. Cetera is under separate ownership from any other named entity. Archstone Financial is not a subsidiary nor controlled by Cetera Wealth Partners. The views stated in this podcast are not necessarily the opinion of Cetera Advisor Networks LLC and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Due to volatility within the markets mentioned, opinions are subject to change without notice. Information is based on sources believed to be reliable. However, their accuracy or completeness cannot be guaranteed. Past performance does not guarantee future results. The guest speaker interviewed in this podcast is not affiliated with or registered with Cetera Advisor Networks LLC. Any information provided by them is in no way related to Cetera Advisor Networks LLC or its registered representatives.